We got Cody on the line here. What do you want to ask him?
How did you get through the analysis paralysis?
So I guess my number one piece of advice is just know your rents dead to rights, not trying to be top of market for your class or for your comp set. Then at the end of the day, having the right kind of mindset, right? I think oftentimes, and you'll see this in real estate, but also in a career, is that you will underperform what you think you're going to do in year one and overperform over 3 years.
Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and very excited for today's show. We got another Ask the Expert episode. 2 guys on the line with us, and we're just going to have a little bit of fun today. So we got Cody Littlewood as our experienced investor and Jeff Helms as our aspiring investor today. So guys, welcome to the show.
Thanks for having us.
Yeah, thanks. Appreciate it.
Absolutely. So Cody, you're up first. How's it going, first of all?
I'm doing good. It's been a good day.
Awesome.
Friday.
Yeah, I love when people come here having good days. So we just closed on a property. So yeah, very good day for me. But
this morning?
Yeah, about 25 minutes ago, actually. So
Congrats.
Small JV deal in Houston. But
cool.
Anyway, yeah. So good day here all around, I think. But anyway, Cody, tell us a little bit about yourself.
Yeah, no, absolutely. And so my name's Cody Littlewood. I'm a principal at Carbon Real Estate Investments, better known as Carbon. We buy value add multifamily here in the Southeast. We have, between me and my partner, we have about 1,500 doors, maybe 250 million in assets under management. And we specifically are buying kind of that Class B workforce housing in suburbs of primary markets, secondary markets, and tertiary markets, throughout the Southeast, and usually with some sort of significant value add component. Yeah, I mean that's what I do now. I used to be a software engineer and built a software company, and then kind of moved into real estate. I can talk a little bit about that if you'd like.
Yeah, please do. Please go back. Tell us a little bit about your background and
Sure.
Where you were before.
So I graduated graduated college during the kind of Great Recession, 2008, 2009. I had a buddy with a master's degree in electrical engineering working at Ruby Tuesdays. And I was just a dumb communications degree. So I was like, man, I am never going to get a job here, but I knew how to program and was pretty good with computers. And so I randomly got a job down in Argentina. I lived there for 5 years in Buenos Aires, and then moved back to the States as I started to build a kind of consulting firm. And I still sit on the board of that firm now, but I built that firm up to maybe, I don't know, 8-9 million in revenue or something like that. So decently sized firm. We had a lot of rocky years, right? So it is an operating business. It's only worth as much as the cash flow, right? And that cash flow was pretty fickle. So some years we'd make a couple $1 million, some years we'd make nothing, right? Or lose money. And so between that and a couple of really large checks that I wrote to the IRS, I often tell people that, I think if everybody had to write checks one time a year, like we do as entrepreneurs, the income tax rate would be 0, because everyone else, it just comes out of their checks slowly.
They don't pay attention to it. Yeah.
But we have to write these big ass checks one time a year. And you look at it and you're like, oh my Lord, how, and it's so painful to do. So you quickly start to look at, okay, how do I reposition my income into a more tax advantaged kind of scenario, right? And I mean, you're always gonna have some sort of tax liability, but you do start to kind of try to migrate that income into a more, long-term capital gains, less away from active, see if I can do anything to offset it with, depreciation, et cetera. So I talked to my CPA and started kind of complaining to him after I wrote one really big check. And he said, well, have you thought about buying real estate? And so I hadn't, and I started listening to podcasts and doing a bunch of research, et cetera. And then I bought a single family home. I absolutely lost a bunch of money on it. And made a bunch of mistakes, but I learned a ton. And then I did a duplex, and all of a sudden that was kind of working out. And I really kind of found a passion for it. I was building software for these faceless corporations, and then all of a sudden I was providing housing to people. And that just felt like a much better purpose in my life. And I really kind of started to fall in love with that. And so I started to do more and more, and kind of would like level up each deal I would go.
Yeah.
Really, I kind of hit a point where the smaller deals, I was trying to replace all my, remember my two goals were like maximize tax efficiency and then also maximize the steadiness of my income, and migrated away from just my software business, which produced a lot of cash some years, but other years would do quite poorly. And so I was trying to migrate it over there. And, quite frankly, at where I was at in my life, I realized I was going to have to buy a lot of damn duplexes and quadplexes to get to where I wanted to go. And so I bought a next deal I bought was a 22 unit that had a bunch of a storage component. And that started to really spit off some serious cash flow where I was like, okay, now I see a path. Right? Like now it's just like $100 a month. Now it's like $5,000 a month or $6,000 a month, $7,000, and it was continually growing. And I was like, okay, this could really work. And I kept falling more and more in love with it. Next deal I found was a 40 unit deal. And it was the first time I raised outside capital. It had to be Fannie debt. So I reached out to my now current partner who had built a large portfolio in Chicagoland working with a family office. He's like, he's a genius. He's ex JP Morgan fixed income trader, valuation expert, et cetera. And he moved into private equity and started buying real estate. And I said, well, hey, I don't have my Fannie card. For those of you guys that don't know, it can be really hard to get your first Fannie debt. They usually want to see a KP that's worth, that has a good track record. And so he agreed to come on as KP and, and be my partner on the deal and kind of check my work, et cetera, which was great. And also I wanted to have a more experienced person on board because I was going to take some outside money from some buddies. Yeah. So anyway, so we raised the money and bought that deal, and kind of the rest is history. We worked really well together, me and my partner. And I really fell in love with what I was doing, and I wanted to continue. I'd scaled and I'd built an operational business before. And so I think about everything in investing as a business. I think of every apartment building we're buying like a $2 million revenue, and let's say a 150, apartment or door apartment building is a $2 million revenue business, right? Yearly revenue business. So I really kind of fell in love with the operational side of things. And and like I said, I just was way more passionate putting roofs over people's heads. I left my company. I put a CEO in place. I sit on the board now, and I went full time into real estate. So that's kind of awesome. A little bit not too long winded, but gives you a good bit of detail.
No, I love the I love the progression. I mean, had a good solid company that was doing well, but I think what a lot of people don't realize is exactly what you said, where you have some years where you make millions and other years where you're like, I lost money last year, but
lots of money. So
yeah, I think that puts some of the businesses, in perspective. This morning I was at a mastermind with a lot of local business owners, and I don't think a lot of them talk about, that aspect of owning businesses. So I appreciate that a lot is what I'm saying. So cool. Yeah. So as far as, you talked a little bit about some of the reasons you got into real estate and multifamily. I want to kind of like tease that out a little bit more and, talk about, your motivation and what I call your big burning why. So what would you say your why is?
So my why has changed over the years. My why before, I think, was money and stability. And now my why is really freedom. And so I think that's happened to be a little bit personal, I guess, on the show. I think that's happened as I've kind of become happier in my life and have started to have kids and like realize the importance of the time that I'm able to spend with them, and have wanted, I think, before I was very attracted to, a more material lifestyle. And I think now I would say that I'm really attracted to a very simple lifestyle, but a lifestyle where I'm free to do whatever I want to do and where I'm free to pursue whatever passions I have. And then I also have like a really big why that I love building the firm that we're building. I believe in building kind of generational firms, right? Firms that have a very clear succession plan. I've been very conscious the second time around about building a business, about hiring amazing executives that can really step into our roles and allow ourselves to kind of look at the bigger picture and have a little bit more of that time freedom. But, I think my kind of, on my vision board is to be able to walk out of my door and I live here in Miami, and, if I ever go back to Utah, it'd be a little bit different, but to walk out my door any day, see it's a beautiful sunny day and take my son fishing. Right.
Yeah.
So, and that's kind of, I guess, I'm not one of those guys that's like, I highly believe in hard work, but I do want I do love the flexibility and the time freedom.
Well, there are plenty of places to go fishing in Utah, so
there
we'll
absolutely are. There also are just a little different type.
Yeah. It's trout fishing instead of hopping in a boat. Maybe I assume that's what you're thinking of in the Florida area. But,
yeah. So we do a lot of like deep sea fishing here. But yes, absolutely. There's the same stuff in Utah.
Yeah. Much smaller fish, but a little different environment. But
more bears.
Yeah, more bears. Yeah, got to watch out for the bears. But well, cool. Hey, thanks for explaining that. One question, we talked a little bit about some of the properties you did, but if you want to do a little deeper dive on one of them, let's do that right now. Talk about one of the properties that you guys have done.
Yeah. So probably one of the cooler properties we bought during COVID. And I'll tell you, it was that 40 unit deal. It was one of our first deals. So now we only buy stuff that's maybe 125 units and up. But I'm really proud of this one because I think it was just such a cool deal. It was in the midst of COVID. I think it was late 2020 or early 2021. And so things were starting to transact, but there was a lot of people sitting on the sidelines. Rates were also at an all-time low. This deal, this deal had
awesome.
It was amazing. Yes. Lord willing, we go back to that environment. I'm not counting on it, but I'd love to see it soon. But anyways, this deal was owned by a developer. He had bought this beautiful downtown Macon, Georgia. He'd bought this beautiful deal that was only its bones. And I think it was built in like early 1920s, really cool building, downtown lofts, and turned it, like totally redeveloped it top to bottom, new plumbing, electrical. I mean, the only thing left were the bones and the original southern pine floors, which are beautiful.
Yeah.
He didn't know how to run it. His rents were consistently under market. And he also had debt on it that had yield maintenance. So he had a 10-year debt with yield maintenance when he had placed it at 4.5%, and current rates were like just above 3.25. So the yield maintenance, for anybody that knows how the calculation works, the further the spread, and then also more years there are, the bigger, and it had like 7 years left on the debt.
Yeah.
There was a big spread in current rates and what they'd have to, and what they'd have to pay. And it didn't make sense to sell the deal for them at that price, but it did make sense to have an assumption. And so we were able to do a little bit of, kind of financial engineering where we thought, I think no one else really wanted the deal. And so it ended up getting priced at like a 7 cap, a true 7 cap.
Yeah.
Tax adjusted, insurance adjusted basis, which is crazy for a downtown class A.
Yep.
Our tenants in that area are nurses and, or are nurses and residents at the med school and law students at Mercer. Right. So, I mean, it's a really nice property to be buying at a 7 cap when everything else in A class was trading at least a 5 and probably lower. And so, but no one wanted to buy it because the debt was so unattractive. When you could get 3.25% or 3% debt, right? No one wanted to buy something that was at 4.5%.
Yeah.
But we looked at it and kind of said, listen, on a historical basis, 4.5% is not bad debt.
No, it's not.
Buy this and pay an 8 pref day one. And we can hit our pref we'll be in the money as a general partnership from day one. We'll be able to return cash flow immediately. It's a irreplaceable asset in a downtown that has just had $700 million of investment. And so we pulled the trigger. We bought it. I think we've taken rents from we benefited, granted, right? Like, this is not me being a genius. We thought we were going to take rents to like 1,100 and we've taken them to 1,475, right? From maybe 875. So we've blown our pro forma out of the water, but the whole market has. And so I want to be, I like to be cautious about that. I think lots of people take amazing, credit. Our underwriting was so conservative. I think we were conservative, but but a lot of that credit's just the state of the market. And so that deal's been incredible. Year one, it did 11% cash on cash. And this year it's going to, the following year it did like or it was on track for a little bit more. And this year, I think
Yeah.
it's on track for more than that. And that's an amazing deal to get into. And we're going to hold that deal for God knows how long and be very, very happy with it and be very happy with the basis. So
I like that idea. We're going to hold the deal until, whenever. I want my kids to own that deal. That's kind of the new philosophy I have on a lot of things is, number one, I don't want to die anytime soon, but I want to pass a lot of the stuff that I buy to my kids. But a couple of things there. Yeah, we assumed a loan on a property at like a 5.1, but we ended up getting over $1 million discount on the market price to do that. And this is when rates were at the threes, and similar situation on that one. On the flip side, we had a longer term yield late maintenance loan that we were able to let somebody else assume recently because interest rates flip-flopped. So
if you're willing to take a discount, like if the seller was willing to take a discount, it made sense for you to be able to buy that. I think people remember that you date a mortgage and you marry a basis. You marry your basis, right? Your basis is forever. So if you buy something at this basis, you're going to own it at that basis till the end of time. Right. Unless you sell it and rebuy it, and your mortgage is temporary. And so if you can do things like you said, you probably got an excellent sale price because your low basis mortgage was an asset versus that seller where his high base or his high, his high interest mortgage was a liability, and he had to compensate you for that with your basis. But it made sense for you because you care about your basis. So
yeah. I mean, we've made those assumptions with that nasty yield maintenance. And personally, I don't think I'm going to buy anything on a yield maintenance, ever again. But yeah, we've made it work twice, both times in our favor. But on the flip side, with a property that we had somebody else assume from us, there were a couple of years where we couldn't have sold that one. But anyway, last question. Here it comes. Cody, what's next for you?
Yeah, I think what's next for me, I mean, we are doing our first fund right now, which is kind of a cool concept. Nice. It's a sponsor capital fund where we're doing, where we're going to make up like 25% of the next 5 or 6 deals that we do with the fund. And then the other side will be larger LPs. And then the LPs in our fund will actually get 25% of our promote back. So it's kind of a cool little thing. And that's what we're working on right now. We've never raised a fund. We've only done deal by deal. So that's our new challenge. I think we're just about to launch and we're 50% committed. So we're pretty excited about that. It should go well.
Awesome.
But that's our next challenge. We think that, over the next 18 to 24 months, we don't believe that there's going to be widespread, massive distress, but we do think that there's going to be some spot distress in the marketplace. We're under contract on a deal right now that is a distressed seller because of debt maturity, not because of the deal. And so, bought peak December 2021, 2-year bridge debt, or August, I guess it was. And now he's about to, have to buy a cap. And, I think we're going to see more of those deals, either buy a cap or refi, and he can't refi given where rates are, and all his assumptions moved against him. I'm pretty excited about the next 18 to 24 months. I don't think that it's going to be like, I think some people think it's going to be a 2008 moment. I do not think that. I don't see any data to represent that at all. But I do think that there are going to be great deals to pick up at a fair basis. And over the course of a rolling 10-year basis, we're going to see some of the best returns right now, even though it's when people are precisely because it's when people are most scared to deploy. So that's what I'm working on right now.
Awesome. Yeah. A lot of similarities there. I mean, I'm going to butcher the quote, but Warren Buffett has been attributed to saying, when everyone else is greedy is when you need to be conservative. And when everyone else is being conservative, you need to be greedy. And there's a lot of people that have, jumped to the sidelines, and, I'm still buying. I think sometimes they're smaller properties, sometimes they're larger properties, but I think long-term, as long as you have that long-term outlook, it doesn't matter. But that's my opinion. But anyway, all right, we're going to shift gears and bring Jeff on. Jeff, how's it going, man?
It's going great. How are you?
Doing really good. Really good. Thank you. So do us a favor. Tell us a little bit about yourself.
Well, I'm a commercial real estate agent here in North Carolina. I got my license back in 2019. I was still working a W-2 job at that time. I'd been there for 15 years, I guess, or right at 15 years when I started on and decided to get my real estate license. I'd gone through a divorce back in 2017. And I felt like it was time to do something a little bit different than what I had been used to, my previous 25 years. Initially, whenever I started, to give you a little bit of background about me, I started out as a welder. Whenever I was 14 years old, I started welding. I started building handrails and stairs, spiral stairs, things like that. My dad owned a welding shop here in Stanley County with a friend of his. And that's where I started learning how to weld and fabricate. So I was in high school doing this. And shortly after high school, they broke up. He started setting mobile homes. So I went into that with my dad. I just followed along, with him. I guess I wanted to help him as much as I could and do the things that he was doing. So I did that for a number of years and eventually left that. Whenever I got into mobile homes, we went from the footings to complete finished product, go back and do the surface repair work. So I had several years of that in my life. When I got out of that, went back into welding and continued on until I met up with some people at Martin, Sprocket and Gear, which is actually CCI at the time. And I progressed through there, got into robotics, got into CNC programming, eventually worked into the engineering departments. Yep. And eventually led up to a supervisor position in Atlanta for a year. That went all the way through until 2018 or 19. I got my license. COVID came through. Some of the things changed within the office, and I decided to go out onto real estate full time.
Nice.
And I've been in real estate full time since then.
Awesome. So yeah, thanks for walking us through that career. It sounds like you've had a pretty exciting career for a while, but talk to us a little bit about, getting into multifamily and what's driving you to do that.
So I think the biggest thing driving me to do that, whenever I got my real estate license, I started meeting people that were investors in real estate. Some of them were investors in single family, and then I got to meet other people like Charles Seaman. I met him, and he was definitely with Multifamily Investor Nation out of Charlotte. I started going to some of their meetups, and that was something I never knew, that you could actually put a group of people together to purchase an apartment complex. Because in my mind, I thought that was something that was unattainable. You had to be a big corporation to be able to own something like that, and I never did look into it. So realizing that was not the case, I started going to more of the meetups. Trying to learn the underwriting, which I kind of let that kick my hind end for a while, because I think it was just more tedious and unobtainable. I mean, I could definitely do it. I just let it control me for a little while, just the fear of it, I guess. But as things have gone by, I've met some people that are, some great people. Him and Badiani, I've done a deal with him, a land deal with those guys.
Nice.
He's here in Charlotte.
Yep.
Great group of guys. So I've met some interesting people throughout the last few years in real estate that are into multifamily, into development and things like that.
Yep.
It's kind of pushing me it's making me realize that, anybody can do it that sets out. You just got to get the right team built to continue on.
Awesome. That's definitely part of it, is linking up with the right people. So, so let's talk about your deeper motivations, your why. What's your big burning why?
Kids is probably my biggest. No, there's definitely an aspect of wanting to just be more free, just like Cody was saying, because I'll be 54 next month. So I want to be able to go and do some things that I want to do. But the biggest why are my kids. They're 25, 26, and 33. And I've got 3 grandkids. Yep. That range from 3, 7, and 10. So I want to leave something, whenever I do pass on, I want to leave something that they'll have the option to either continue on doing what they want to do. Yeah. They can see that there's something better out there, and they continue on with what I've left. So that's really my biggest burning why. Is having something for them later on.
Nice. That legacy.
That I was able to provide.
Awesome. Well, we got Cody on the line here. What do you want to ask him to help you out on your journey?
Hey, Cody, how are you? How did you get through the analysis paralysis?
Yeah, that's a really good question. Well, I mean, you have a little bit of a leg up, I think, in that you're a commercial broker. So you've probably, one thing, if I were you, I'd probably go back and look at the deals that have done really well and that your clients have really loved, and then maybe see if you could spot some similarities. I think that would be like one thing I would be thinking about. But I mean, at the end of the day, I think the better you know your rents, the better you know the rents that you need to hit. And if you can maintain everything else, in a stable state, that's like the number one crucial thing. I always tell investors, that are investing with us, is like, listen, if you more or less know the rate we're going to fix, if you, if you believe this tax consultant's tax numbers, right? If you believe the insurance broker's insurance numbers, right? Like we're using experts to find these things. If you believe that, the water bill is what the water bill is, and you believe this and this and this, really all you really care about is, can we hit the rents, right? Can we hit the rents is probably 90% of the returns. And then the rest, the additional, or 80%, it's like the 80-20 rule. The additional 20% is really going to come from, the additional 20% is really going to come from, organic growth over the next few years. And did we hit those numbers or not? Right. But so I think just knowing your rents backwards and forwards, and knowing exactly, having comps that you feel dead to rights on, not trying to be top of market for your class or for your comp set, then at the end of the day, having the right kind of mindset, right? I think oftentimes, and you'll see this in real estate, but also in a career, is that you will underperform what you think you're going to do in year one and overperform over 3 years. And so I think having the staying power and being conservative enough on like stuff like the debt, don't get upside down on debt, don't get upside down on, on ability to cash flow on debt, and mostly everything will kind of work itself out. But I think, I guess my number one piece of advice is just know your rents dead to rights, right? And know what you can hit dead to rights. And then everything else, you're going to be able to control for fairly well.
Yeah. Yeah. I mean, the analysis paralysis, everybody has that. I remember getting to a point to where I realized that I wouldn't learn anymore and I wouldn't progress anymore. And I was stuck in that paralysis for a long time. But for me, it came that point where it was just like, I'm never going to get an apartment. I'm never going to do better. I'm not going to be better unless I start taking action. For me, it was just, I was stuck in it forever, but the realization finally came after dawdling for, 6 months to a year and, telling everybody what I wanted to do. It was just like, I've got to actually start doing it, So for me, it was just that realization that I was stuck in that paralysis. When I realized I was stuck in that paralysis phase, it was really easy to say, okay, here's where I'm at. I just got to start doing things, and I remember throwing out an offer, without an LOI, just an email with a number, which was not well received, but, it also showed me that the world didn't come crashing down because I put an offer out like that. I realized that, oh, hey, yeah, she didn't, that the broker didn't, tell me I was stupid or anything like that. She just said, yeah, this offer's a little low. We're going to move on. All right, cool. So
I'll say it's kind of, it's trite, but like the Nike logo, just do it. Once you start plowing forward, right? And especially right now, right? You don't even have to have hard money, right? Get into due diligence, take that first step, just do that first step and then do that next step and then do the next step and then do the next step, right? How do you eat an elephant, right? One step, one bite at a time. Yeah. And you're going to actually realize, like, after you do the first one, you're like, oh, that wasn't that hard. So.
Yep. All right.
What was your biggest challenge to overcome whenever you started investing in real estate?
Learning how slow things move in real estate versus an operating business. So you can quickly slip on, like, in multifamily, you can quickly slip on delinquency. And especially if you're in a value add process. Okay, let's use an example of like a 200 unit building. And let's say to hit our value add plan, we want to do 8 units a month, right? But we also have, so, and that's fine, right? We can probably, normal absorption, we can probably rent 8 to 10 units a month, right? So we should be good. But let's say a bunch of evictions hit, right? We got a bunch of delinquency, a bunch of evictions hit. And then all of a sudden, we have 2 or 3 months of that. And now we're down at 80%. And now to hit back to our 93% occupancy that we want to be at during a value add, which is, like 8 units being turned every month. Now we've got to rent, 8 plus 20. Right. To make up for that 10%. So now we got to rent 20 a month. Right. And we're probably not going to rent 20 a month. We're probably going to rent 12, 14 a month for the next 3 or 4 months till we catch up. And so you can quickly slide, and then it takes a long time to get back. And that, I guess that was pretty frustrating for me at first to learn, but I think it was a good lesson. And now we look at our numbers very early because we know as soon as we start to see something slip, we know how long it takes to get back. And so I think it's made us much more vigilant than we would have otherwise. So I guess that was the most frustrating thing for me, or one of the hardest things for me when I first got started.
Yeah. We had a couple properties that slipped like that too. And I mean, there's a certain momentum that goes with the slippage. And if you don't jump in immediately to start that momentum, by the time you jump in, it's still going to go down, after you start, trying to right the ship. But yeah, I think the biggest thing for me was overcoming my own self-doubts. That was, before the first property, that was kind of it. It was just, can I really do this? And, quite honestly, those self-doubts are still there, but I think I've learned how to handle them a lot differently and a lot better. But that was really my biggest struggle, 100% internal.
Can I say something about that I think
Absolutely.
Really, so I go to I have a couple masterminds, good friends of mine, guys that are doing, I got a buddy that raises $100 million a year and deploys into self-storage, massive self-storage private equity firm. And we went around the room and like all these guys are just total badasses. They're all crushing it in their own right. And we went around the room and somebody brought up, imposter syndrome or like self-doubt.
Yep.
And every single person in the whole room had it, right? Every single person raised their hand. And it was like 20 guys that are absolutely like crushing it on every level of their life. So I don't know if that's helpful or not, but it's
I mean, yeah, it helps me because, I still struggle with it, and hopefully it helps everybody else because you just realize that, yeah, that imposter syndrome, that self-doubt, the successful people just push through it. It's not that they don't have it. They just push through it.
Yeah. Yeah. We're all our worst critics for sure.
Yeah, for sure. Absolutely. So Cody, how did you determine your buying criteria starting out?
So I was really like focused on, I didn't have a strong enough criteria at first. So I don't want to say I had a massive criteria. I was looking for a good deal. So, and what did the ability to cash flow immediately, the ability to refi out a significant amount of proceeds after a couple of years, because I felt I had kind of a scarcity mindset about how much capital I had. And then the third thing was, was really high returns after that refi, right? On a cash on cash basis. And that's really what I was looking for. Over the years, I've gotten much more specific about my criteria, but I think that only came with experience. And like doing a few deals that I was like, okay, I don't want to do that again. So like that sucked. So I'm not looking at anything that's a C-class property, right? By the way, there are guys that are crushing C-class properties, right? That make a ton of money on C-class properties, but that just wasn't my thing. So I think I just learned pretty quick, but I wish I had a better answer for you. I would look at what your personal goals are and build out criteria based on that. And then build out criteria based on your strengths, right? You're a local commercial broker, you have a very unique position inside your marketplace. So for me, that would be very hard to ignore as far as a criteria, right? I wouldn't be like I wouldn't be buying stuff in, I'm in Miami. I wouldn't be buying stuff in Northern Florida, Georgia, the Carolinas. If I were you, I'd be focused on sellers I knew, right? And maximizing my leverage, which is my local relationships. But I didn't have that. And so I played on other strengths.
Yeah. And I've got the same thing to admit. I didn't have great criteria up front and I didn't realize it at the time, but that was really part of the reason why I didn't get initial traction, because I would call the brokers and say, I just want a good deal, and they didn't know what to show me, so right now, I mean, I am kind of in the middle of a pivot right now where, new company, new location. And it's amazing how having that criteria changes the conversation with brokers when you come in with a very specific criteria. Part of my criteria right now, like Cody said, was based on experience. I'll do C class if it's a C plus and I can end at a B. Otherwise I don't want to do C class again. And the other part of my criteria, and I think this is what a lot of newer people don't really figure out, is, how much can you afford? If you're syndicating, how much can you raise? And that amount of money you have to kind of walk in the deal backwards saying, okay, I can raise $1 million. $1 million is going to buy me a $3 million property, and then take that and translate it to unit count wherever you're at. So that's how I probably should have done it, establish a geographic criteria and then come up with a dollar amount based on how much I can raise and how much loan we can qualify for. Obviously you bring in KPs to help, make that number a little higher, but I think it really has to be informed by how much equity you can bring to the table.
How did you determine how much? I mean, if somebody's starting out and they've never raised money before, how do you say, well, I can raise $1 million? I have no idea. So how do you come up with a number, to be honest?
That's a good question. I kind of soft circled it with friends. I got the deal under contract, and then I started reaching out to buddies of mine and friends and other entrepreneurs and people that I knew that would be interested. And this is kind of weird, and it's not very helpful. But I will say that, like your first deal, I would say any deal, actually, the better the deal, the easier it is to find money. And I've always found that when I've had a really good deal, I've found the money. So I know that's not super helpful, but I'd probably start, I think one of the best things you can start doing is start talking with everyone about what it is you're doing,
right?
What it is you're planning on doing, what your secret sauce is, how you plan to leverage that. And then from there, kind of start to gauge some interest, right? Like, is that something you'd be interested in? I'm going to start to raise some outside capital. Would you be interested in allocating? And if so, how much? And then take that number and times it by like 2.
Yeah, right. Makes sense.
Yeah. That's really the way right there. You socialize it with other people, and, you can combine your efforts with somebody else. You can bring other people in and, hey, I think I can raise, X amount. How much do you think you can raise? And, like Cody said, I think he said when he has a good deal, he's always made it. I'm guessing there's probably a lot of hustle that was involved in there as well. But that's the other part of it as well. Come up with something, I tell people all the time, if you think you can raise 500, if that's a little bit of a stretch for you, fine. I mean, it's okay to stretch a little bit and hustle. Just make sure you're not stretching too much to where, it's kind of an impossible thing to hit.
That makes sense.
Yeah.
Cody, what did you do to go about building your team? So I'm starting out brand new. I don't really know. Well, I do know some people now at this point, but how did you determine how to build and who you wanted to be on your team?
I kind of started looking for like where my weaknesses are, right? I think, and where my weaknesses are. And then me and my partner would try to cover all areas of the business until we started to feel stretched in one area. And that's really where we'd build out. But I think your business needs 3 main areas, right? And that's operations, that's the ability to place capital, and then the ability to find deals, right? And so generally speaking, the 3 strong legs of the stool that you need to run this business are those 3 pieces. And then I'd figure out, what are you worst at, and try to hire for that. So that's kind of how I thought about it.
So you have somebody that's complementing your weaknesses.
Yeah, absolutely.
Filling in those gaps.
Yeah, absolutely. Well, we are about out of time. I just looked at the clock. I'm like, oh my goodness, we are there. But so one last question for each of you to wrap things up. And Cody, you to go first. How can listeners learn more about you?
Yeah. So I think the best probably way to find us is to go to investwithcarbon.com. And you can always reach out to me directly. I'm on Twitter at Cody Littlewood. And we also have a podcast called The Road to 100. So come listen to me and my friend Pasha Sfendieri talk to investors and business owners and entrepreneurs about how they're trying to, what they're doing on their road to 100 and in their lives and their business and, in their health.
So what does the 100 mean in that context?
It's just like if you've ever seen the emoji 100, right? So
so you're getting like 100% or
100%, right? Yeah. Okay. So whatever your goal is, I think it originally started out as like road to 100 million, road to 100% your relationships, and road to 100% your health, right? We really believe in kind of that full. We like to interview people that are kind of full life rounded people. Yeah. It's definitely got a heavy investment and business focus, but we like to throw in those things as well because we think they're an important part of life. So it's just kind of road to 100 in all those categories, and we try to interview guys that are crushing it. We've had everything on there from like the guy that bought the Golden Nugget, to a guy that built a $40 million pharmacy franchise. So nice. We've had a wide range of people on there.
I think I know who you're talking about with that one. Anyway. Awesome. Well, same question for you, Jeff. How can listeners learn more about you?
So you can definitely hook me up on LinkedIn. It's Jeff Helms. I don't know the LinkedIn handle, but it's Jeff Helms on LinkedIn. And then on Facebook, it's Jeff Helms CRE, and Instagram the same as Jeff Helms CRE. And we have a meetup every once a month. Well, actually twice, because we do the Multifamily and Investor Nation meetup with Charles and William Edwards, and then we do the Cash Flow Champs meetup as well.
Nice.
And just reach out to me on Facebook or Instagram or LinkedIn, and we'll hook you up on our meetup.
Perfect.
Awesome.
All right. Well, thanks, guys. Appreciate your time. And that's a wrap for today.
Thanks for having us.
Yeah, thank you.
Awesome.
I appreciate it.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.